The US-China trade war has de-escalated and stimulus measures have been announced in China. What does this mean for base metals? I'm Fiona Cincotta at StoneX, and to delve into this and more, I'm joined by Senior Metals Analyst, Market Analysis, EMEA and Asia, Natalie Scott-Gray. Thank you for joining us, Natalie.
Pleasure to be here.
So since we last spoke a week ago, there's been a flurry of headlines in the market about developments in China, from trade talks to policy announcements. Perhaps it's best if we start by outlining, or you outlining, exactly what has happened.
Of course. I think the way that I see it for China, there's been three main developments over the last week. So the first one, of course, front and center, has been the trade talks between China and the US. They occurred over the weekend in Switzerland. Now, arguably here, I think the market was a little bit taken back by the fact that both countries agreed so quickly to reduce tariffs on each other by 115%. So where that's left us is that the US has 30% tariffs on Chinese imports. So the original 20% there remains. That was issued over February and March, at the beginning of this year. This is the US's view that China hasn't prevented exports of fentanyl, and then the extra 10% makes it 30%. Meanwhile, China has now reduced their rates from 125% against the US down to just 10%. In addition to this, the US also made other concessions, which was interesting. So this refers to the de minimis duties, which is when goods are shipped into the US, which are under $800 per person per day. The US administration has now lowered this from 120% tariff to 54%, and down to $100 of a flat rate, down from $200 as well. So that was the first thing that we saw, the developments in the trade talks. Then secondly, there has been more policy announcements coming out of China. So this happened the middle of last week. We heard from the governor of the People's Bank of China and other senior officials. They outlined 10 key tasks to help support the economy. These were broad-based, what they covered, but probably most significantly was the change in monetary policy. So here we actually saw a cut to the reserve requirement ratio, also the 7-day repo rate in the country. And why this is significant, it's the first time we've seen a cut to these rates since September last year. And that was the first time that China actually announced that it was going to release this record level of stimulus in the country. And the level is the highest level since the global financial crisis. So it's interesting that they've now chosen to do that just ahead of the trade talks. And then the final development that we had is the release of initial April economic numbers coming out of China, which show partially the impact to the Chinese economy of when the tariffs between China and the US did stand at that 100% level.
Okay, so lots of developments. I mean, just how important is the health of China's economy when it comes to base metals?
I mean, it couldn't be more central for the outlook for base metals, because China is the biggest producer and consumer of these metals. So just in the case of copper, if we were looking at demand, then last year China accounted for 58% of demand. So almost 2/3 of global demand is just based in China. But even taking a step back and looking at China on the global kind of macro stage, I think the pace of tariff reductions in the US that has occurred so quickly that they put them on, they took them back. Potentially it's outlining that the US not only underestimated the importance of Chinese trade, but actually its stance in the global market and the impact on global macro health as well.
So taking this all into account and these developments, have they changed your view in the outlook for base metals this year?
Very good question. It is not a simple yes or no, I would say, because there's just so much uncertainty that remains. If we break down maybe the macro key drivers, so when it comes to forecasting base metal prices, there's three key areas we tend to look at. So firstly, the pace and path of monetary policy. We always look at the health of China, as we've discussed, and we look at the risk of an escalation or a de-escalation in geopolitical tensions. So if we are under this scenario, let's say that China and the US keep tariffs at this lower level and how that impacts these drivers, then in the case of the path and pace of monetary policy, I mean, unfortunately, we don't have enough data yet on the impact to the US economy from when these tariffs were basically 100% against each other. So we can't tell the full story there, let alone what the impact will be now they've pulled them back. So the Federal Reserve is likely to remain on pause for longer because they have been very clear that they want to stick to their dual mandate, which is maximum employment and price stability. Now, on Tuesday, we did have CPI numbers for April come out of the US. They came in lower than the market was expecting. So initial thoughts were, the impact of tariffs isn't as significant on inflation in the US. But to be clear, that's not what our view is. We do think there is a significant delay in the impact when it comes to inflation. So we're not expecting peak price really until late summer or early fall at the earliest. So given that the Federal Reserve will be aware of this, they're not going to want to roll back on policy if they do make a decision. I think it is unlikely that we'll have a rate cut until the second half of the year. And ultimately, the longer that we have higher rates, it just delays the cyclical demand recovery that we expect for the demand for industrial metals in the country. So reduction in rates here in that scenario ultimately has just led to more uncertainty and probably a longer waiting period there. If we look at our second driver, so the health of the Chinese market, again, we only have 1 month of solid data, which is March data in the country, to kind of analyze the impact of tariffs. And of course, the March data can't tell us the impact of 100% tariffs because they weren't implemented yet. But just looking at the March numbers year on year, so where we were in March versus this time last year, we have had outperformances in the country for GDP, for industrial production, but actually retail sales, fixed asset investment were weaker than where we were a year ago. The jobless rate hasn't changed, and we still have deepening declines when it comes to property investment and property sales. So no stability there. Now, if we combine it with the initial April readings that we've had, then PMI manufacturing in the country has now fallen into recession, so fallen below that important 50 level. And inflation readings that we had over the weekend has shown that CPI has fallen for a third consecutive month in the country. PPI, so factory gate prices, has been in decline for 31 consecutive months. So when we're looking at the health of GDP growth for Q2, it is starting to look a little bit more precarious now, particularly when we look at GDP in Q1, because that did outperform, but it was driven 40% by this front loading of exports. So even in this scenario where US and Chinese tariffs are lower, any elevation in tariffs, of course, is a negative when it does come to Chinese exports. So there is a question mark over growth in the second half of the year for China, and we do expect it will come in lower than Q1. And again, that's holding a bearish parameter on base metals, regardless of the fact that we've had these trade talks. And then finally, on the macro front, the risk of escalation or de-escalation for geopolitical tensions, as we're well aware of, we're not out of the woods yet. And between the US and China, they've got a 90-day trial period to try and make a deal, which isn't that long, that runs out on the 8th of July, which will come around sooner than we expect. We also have the 90-day period where the US is trying to make deals under these reciprocal tariffs with all of its trade partners, and that date is actually going to be before July. And in addition to that, we are expecting that the US administration is going to announce sector-specific tariffs at some point. We don't know when, but we hear pharmaceuticals, semiconductors, lumber, copper, as we've discussed in the previous week. So we really can't rule out that there's going to be another escalation in US tariffs overall. So in summary, I guess, after all of that, to answer your question, the reduction in trade tariffs for the moment does help to take the worst case scenario outlook for base metals and for China. It softens it a little bit. But we have to realize that actually we've got the reality. We're going to have weak economic numbers coming out of the US, coming out of China from that initial impact of tariffs. And if we combine that with the fact that there could be a further escalation in trade tensions, then in this environment, we continue to hold the view it is unlikely we're going to see a nominal high for base metal prices, specifically copper, in the next few months.
Brilliant analysis. Thank you so much for your time once again, Natalie.
Pleasure. Thank you.
For more videos like this, please do like and subscribe.